Hey everyone, happy Thursday, July 31st. It's about 9 or 8:45 in the morning on the West Coast, and it's time for another market update. It was a really busy week in the markets, probably the busiest I've seen as far as data and narratives. So busy, I ran out of space in my PowerPoint here, so I had to put myself over in the corner. So I'm going to get right into it. First things first. Yesterday we got the most recent Fed meeting ended, and as expected, they did not make a change to their rates. However, there was quite a bit of dissent in the ranks. For the first time since 1993, two of the voting members, Governor Waller and Governor Bowman, voted against the rest of the people. They wanted to cut the rate by a quarter of a point. So again, first time since 1993, and one other, Goolsby, based on comments, he was on the fence. He almost probably did that as well. So that was good to see, and we kind of saw that coming in. However, afterwards at the press conference, the markets were really expecting Chairman Powell to be in a more dovish tone. So, dovish meaning a little bit more friendly to the markets, not so much we're going to keep rates where they're at. And he was, he was a little bit more hawkish, meaning he was talking about tariffs, and we haven't seen all that, and what's going to happen in inflation, and they haven't made up their mind about the next meeting and so forth. So markets didn't like that, but overall, it wasn't the worst reaction. Just down a little bit after the press conference. So that was good to see. But again, really, it's going to depend on the data coming up before that September meeting, because going into this meeting, most people thought September they would cut. Now that's flipped to 40% they won't, or 40% they'll cut, 60% they won't. Next thing, it's actually jobs week. And like we've talked about, jobs is very important. Fed's paying very close attention to jobs. First one we got was June JOLTS report, which is job openings. And that dropped by 257,000 to 7.437 million. The hiring rate dropped to 3.3, which is the second lowest once you take COVID out since 2013. So again, maybe the first sign of weakness we see in the jobs report, one of the first signs is companies aren't not posting as many jobs. They don't have as many job openings. They're not hiring as often. So again, that's important because the Fed is looking at this, and a lot of it has to do with labor. If the labor market starts to crack and show signs that, hey, we're in trouble, that's when they're going to cut rates to stimulate the economy. Next thing we got was July ADP. So this is a private payroll. This is our first look at payroll and jobs for the month of July. And it came in at 104,000 jobs created. Last month, remember, was negative 33. They revised that up a little bit to negative 23. Expectations were about 80,000 jobs, so it wasn't too crazy high. And the market's really, this one is kind of gone away. The BLS jobs report is tomorrow, and that's the big one. And over the last few months, it really hasn't, they haven't been connected over the last couple of years, even. So I think the markets aren't giving this as much credit, because really the one that matters is tomorrow. And this isn't giving us a good idea what's going to happen tomorrow. So again, mainly large and medium businesses that brought on the jobs. Annual job stare or pay increases for annual job stairs dropped a little bit to 4.4. Job changers, so people switching companies, stayed at 7.0%. So that's our first look. Again, pretty muted reaction there. And then again, BLS tomorrow, that's the big one. That's our big enemy. It's been a killer. It's supposed to be about 110,000 jobs created, and the unemployment to go up a little bit from 4.1 to 4.2. So that's a very, 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 very important jobs report tomorrow, especially with everything going on, especially the Fed seemingly on the fence about what they're going to do next. Next thing, we got June PCE. So the Fed's favorite form of inflation. So that came in basically as expected at 0.3 headline month over month, at 2.6 year over year. And the core, which takes out food and energy, which the Fed really keeps a close eye on, was up 0.3 to 2, and then 2.8% year over year. One thing to point out, that they did make some negative or positive revisions up the numbers a little bit from last month. So the year over year and core especially went up a little bit more than expected, but it was because month over month it really wasn't that much. It was last month's revision that did that. And the markets again aren't reacting too negatively. It's actually a positive day in the markets after this came out. So one thing to point out too is analyzed core, the run rates are not as good as they were last month, but still better than they were even a few months ago. So 3-month run rate for the core is at 2.6. So that's the average just over the last 3 months, I don't know, the last year. The Fed wants to get this down to 2%, though, and that's going to be tough. Tariffs are still going to be factored in at some point if we haven't already. The upcoming months after this, there's not a lot of good replacement months. We're replacing last year's number, a high number with a low number. So it'll be interesting to see what the Fed does if inflation core stays around this area, but then we see jobs start to crack. Next thing we got was appreciation. So we got first look at home appreciation for, I believe, the month of June. Oh, May. I'm sorry. Yeah, I forgot the appreciation. Lags a couple months. So first one is Case Shiller. That's the gold standard. That dropped from 2.7 year over year to 2.3%. So it's still going up. It's just slowing. And one thing to keep in mind: the seasonally adjusted for not versus non-seasonally adjusted. So seasonally adjusted, where they do some math and say, hey, this is normally what's happened this time of year, it was down. It was negative at 0.3%. But non-seasonally adjusted, they just looked at the raw data. It was at up 0.4%. So again, keep that in mind. There is some math involved for them to come up with that negative. And then FHFA, which is takes out jumbo and cash loans, that was very similar. Seasonally adjusted, negative 0.2, non-seasonally adjusted up 0.4, and it went from 3.2 to 2.8. So slowing, but not negative. Just in case you see negative things on the media about house prices dropping, and again, that's national. So certain areas, maybe there is a little bit of depreciation happening. But as far as nationally, it's still going up, but just slowing. Miscellaneous stuff. This is where I had to fit everything else. So GDP, first thing, GDP. We got our first look at second quarter. Last quarter, remember, was negative 0.5. This one came out up at 3%. So bigger number. And it was supposed to be about 2.4. And again, the stronger the economy is doing, the more likely the Fed is to do nothing. And we kind of want to see some economy weakness for them to cut. But just real quick, some math teaching real quick. The way they come up with GDP is consumption. So our spending as consumers, investment, business investment, those two added together, add in government spending. And then the last one is the important one. It's exports minus imports. And the reason that Q1 was so low was imports was much stronger. A lot of companies were pre-tariffs were importing things to get it out of the way before tariffs set in, which makes a lot of sense. And then this quarter, it was imports were much weaker. So basically, what we had to do to get an accurate reading here, and even Fed Chair Powell said this, was basically offset those. So negative 0.5 plus 3% is 2.5. Divide that by 2, and really the GDP is more at 1.25, which is not that strong of a number. And the Fed, it sounds like the Fed's aware of that. So that was good to see. Tariffs still a very, very important thing. Tariffs, the deadline's tomorrow, August 1st. A lot of have gotten done over the last week. There's so much going on. We'll have to see how it all turns out, but it seems like, at least most of the countries are falling in line, and there's, some negotiations still going on. So, there's still lots of debate of whether or not that's going to hit inflation coming up. One thing to keep in mind, tariffs are a one-time hit. It's not like tariffs keep hitting. So we'll see one big increase if tariffs hit, and then after that, they shouldn't have an effect as much. And then June pending home sales. Houses that went pending in the month of June haven't closed yet. It's down 0.8% month over month, down 2.8% year over year. Current sales pace under 4 million at 3.93. Not shocking considering all that's going on. Economic anxiety, people 401ks were down, and also obviously rates have remained elevated. Next thing, like I said, there's a lot this week. Initial jobless claims are dropping again. Supposed to come out at 222, came out at 218. Continuing claims, so people on unemployment and not getting off of it, continue to stay really high levels at 1.95 million. So same story. Companies seem hesitant to lay people off. Once people do get laid off, they have a hard time finding a new job, which again, not that strong of a job market. So where does that leave us? Average 30-year conventional. Yesterday, end of the day, about 6.75. It hasn't updated yet this morning. I would say, it's a little bit of a positive day. So maybe 6.74, 6.73. Last week, we were at 6.81. So a little bit of a drop. But again, we've kind of stayed in that range, 6.6 to 7-ish for months now. So, really coming up tomorrow, that BLS jobs report, the market's ready. If we get a good one, and we've said this month after month, it seems like, if we get a good one, the markets are going to rally because that's going to be a good thing for what the Fed might do. If we get another strong jobs report, which sounds like it's a good thing, but not good for rates, that will be bad because then the narrative is going to be like, Fed's not going to cut next time, and we'll see probably some, a tick up in rates. After that, we get CPI inflation on August 12th. I didn't put the date in here, but towards the end of August, we're going to get the new data on PCE, and then we'll get another BLS jobs report before the Fed meets on 9/17. So again, super busy week. Still a lot to be determined by what happens tomorrow. If anybody needs anything at all, please don't hesitate to reach out. Thanks, guys.